let's now talk about selling options on 5 different dividend aristocrat companies, and let's look at it with through the lens of, can we do our safeguards type of strategy with these 5 different dividend aristocrat companies?
Please subscribe to the channel and happy chatting.
And can we sell weekly or every 2 weeks or monthly type of options on these, but primarily weekly? They have to have a weekly option listing. And so that if you wanted to do a weekly type of income strategy with these dividend aristocrat companies, you can, right? It's a lot of companies out there, a lot of ETFs out there that might pay a monthly dividend or might even pay a really juicy quarterly dividend, but the options are not robust, right? They're not robust, meaning that it's hard to play the kind of safeguard strategy, or better known as the wheel strategy, that's out there. At the Dorian Way, you guys know we call it the safeguard strategy because we've added 2 different strategies to it, right? We've added what we call the the collar, which everyone is we didn't name the collar strategy. It's out there, but it's just not as well known as the covered call strategy. And then we named, or Ernie named, the Bionic Bull strategy. So they're all bullish. The naked put, which is in the wheel strategy, the covered call, which is in the wheel strategy, that's bullish. The collar strategy is bullish. It's just a little bit more protection, or a lot more protection than any of these type of strategies we're talking about. And then the Bionic Bull is basically the way that you can be conservative but still have unlimited upside. So you got those 4 different strategies, and if you marry it with some safe companies, and safe is relative, but these companies are safe in the aspect of they've been around for over 25 years. They have paid a dividend for over 25 years, and they have raised that dividend for over 25 years. So yes, it's going to be some up and down with these type of companies, but if you structure the trades correctly with the safeguard, and you're okay with holding them, collecting those dividends, and keep writing calls against the positions, you should make money over time, and it should be better than, or a lot better than, a buy and hold type of process, because you're always lowering your cost basis. And when you hear me say lowering your cost basis, I mean, if it originally cost you $10,000 to buy 100 shares of something, and then you're selling calls against it or selling options against it, and now your position is down, your cost basis is down to 9,000, where you just lowered your cost basis, and then you're continuing to want to make it as low as you can possibly get it as you stay in a trade like this. And you can create some of these. You can figure out which company you want to make like a core position, a company that you want to sell these type of strategies on consistently. Okay? So we've done 2 so far. We've done one. Our first one was in Walmart. This is the and we believe it or not, Walmart's a dividend aristocrat company. It's going to be a kind of a go-to safe haven type of company when things start to fall apart. If we do see some type of recession again, I think this company is going to be just fine. This could be a good one to be a part of. You can see it's been in a range for a while. So we bought 100 shares, and at the same time, what we did was we bought a put, but first we sold the call and then paid for buying a put. So if the call received, let's just say $10 for the call, we bought the put for something less than $10. Okay, something less than $10. And I guess if I should have did, the less than sign, should have did it something like that. So we did something less than the $10. So anyway, we did this on Walmart, and then we also did one on Coca-Cola, as you can see here, and that's also been kind of in a range here. And if things start to go bad, this is another one that is going to be a safe haven type of stock. People are going to flock to it because Coca-Cola is a money making machine. Okay, a money making machine. So, but let's look at 3 other ones, and let's kind of dissect them a little bit. Let's first start by going over in Exxon Mobil. So, household name. You can see that over this. It's up today 1%, over 1%. Year to date, it's up 6%. And I'm talking about right here, everyone. And for the last 1 year, it's up almost 40%, over 39% there. And then for the last 5 years, it's up over 51%. So this has been something that not only can consistently pays a dividend and raising it every year for at least the last 25 years, but this is something that gives you appreciation as well. This is the ultimate, it's the holy grail of dividend aristocrat companies or dividend companies, period, because you're getting that appreciation with this one. So if I was going to trade this, we're going to jump over to the TastyWorks platform really quickly. And if we go over here and look at, let's say we're going to do it, this has weekly options. As you can see, that was one of the criteria we wanted to look at, right? And then if we go over to the 7 days, the expiration, let's do one of the strategies that you guys are familiar with. If we did a naked put in here, we can sell a put at any time. That's usually the beginning of the wheel strategy. We can do this. We can collect. If we do the mid, we can collect about 103 if we can get filled. And then our max loss if Exxon goes to zero, it's just about 11,000. You know, Exxon is not going to go to zero. They're going to require you, if you're doing it in a margin account, about 2,100 to hold this position. If you're doing it in an IRA account, you're going to have to put up your max loss, which is about $11,000. Right. So this is a pretty high probability trade. It's almost 70% here. This is how you can buy the shares of Exxon at a discount. And then once you have to take ownership, then you would sell calls against it. You can also take on a trade. You can also decide, okay, well, you can start with a covered call. This is the second part of the kind of wheel strategy. You can start with a covered call, and if you're aggressive with the call, that's buying the shares and at the same time selling a call. That's called a buy right when you do it at the same time, when you don't have the shares already. You buy the shares and you sell the call at the same time. It's called a buy right, somewhat of an old term, but that's the best way to kind of explain it. If you did it this way, you would collect $144 for selling this call. And then if it jumped up past 113, which is only about 15 cents, 14 cents, 16 cents away from that now, you can make $160 in 7 days if it jumped up. If it went down, obviously you can still keep that $147 of premium that you receive over here, but you could lose more than that. It could drop more than that, right? So you don't have protection past this 147 that you're receiving. That can be like a hedge for you. If it drops more than $1.47, then you will start losing. Or you can decide, I'm going to take some of that 147 and I'm going to buy a put and turn it into a collar. Now, this is going into the safeguard strategy of the Dorian Way. You buy a collar here, and now you're only collecting $73, but the most you can lose is 115 in the next 7 days, and the most you can make in this example is $85, right? So you can say, okay, $85 on this on 100 shares, that's awesome. That's better than the dividend that you'll get in 3 months. But you can also decide to say that I'm gonna do it a little differently, right? I'm gonna say, all right, I'm gonna collect almost $100 here and be able to make about 115, and then now I'm gonna lose 190, especially if you don't think it's gonna drop this much, right? You can structure the trade a little differently, or you can decide I'm gonna structure the trade like this. I'm gonna move the 114 up to. I'm going to move this call up to the 114. I'm going to collect almost $100, and then I'm going to buy the put, right? So now I'm only getting 28 in the extrinsic. That's how much someone's paying me, but I can make 140 if it jumps up past the 114, which is only about $1 away. And then if the most I can lose is about 150. So it's about make one, to lose one, right? That's how you can set this up. And this is the collar strategy. Okay, this is the collar strategy. This is more safe than a covered call because you have this put here that's protecting you to the downside. You cannot lose to the downside if it goes below 111 within the next 7 days, and then you can just roll these call and put out and continue in continuation, just like we did the Walmart. If you're not really familiar with that, we don't have a lot of time to talk about the collar right now, but we have the video library in the Dorian Way School. Every member gets it. You can go get that, go look at this collar strategy and study it and dissect it. And then if you still have questions, email support or bring it back to a live programming that we have. So let me talk about one more strategy as we go through this really quickly. Another kind of company that we can look at that's pretty awesome is Procter and Gamble, household name. This is definitely another company that if things start to hit the fan, stuff, people start panicking and so forth, this is going to be a safe haven stock, right? Procter and Gamble. If we look at, we didn't check out the dividend on Exxon, but if we look at the dividend on here on this one, it's 2.6%. That is about 91 cents every quarter on this one, right? But as you can see, it also has weeklies, right? It has weeklies, and so if we wanted to here, we could decide to go to a weekly and do what we call the bionic bull, right? And the bionic bull is when you sell a put and then you buy a call for less. for less than the put that you sold, and that gives you unlimited upside. It's going back to the basics. A call is when you buy a call, you're bullish, and you theoretically have unlimited upside potential on a call, right? When you sell a put, you are also bullish, but you don't have unlimited upside. You only can make as much as the credit you receive when you sold the put. But when you marry those together, that's two bullish positions coming together that we call the bionic bull. And to me, it's pretty nice, especially if you're okay with taking ownership. And that is the premise here. We're okay with taking ownership of these five different dividend aristocrat companies. So if I sold this put at the 140, and then if I decided that I was going to buy this call at, let's just say, the 142, well, I'm going to be able to get a 20-cent credit on this, and then I have unlimited potential for the next 7 days. This is obviously, it's not going to go up into perpetuity in the next 7 days. But it's still how the structure is. If it has a big pop, you can make a decent amount of money in the next 7 days. Okay, so let's look at one more this afternoon. Let's look at Walgreens, right? So Walgreens is a household name. We see it on a lot of the different corners across the country and so forth, but it doesn't bring this kind of warm, safe feeling like Coca-Cola, like Walmart, like Procter and Gamble, right? It doesn't bring that type of feel, but it has been safe in the aspect of getting a dividend over the last 25 years, raising their dividend over the last 25 years. This is a company that you can believe on not going out of business within anytime soon, right? And so this is something you can trade. It's a little less, the dollar, absolute dollar wise, it's a lot less. So if we go here and we put this into TastyWorks here, and we can kind of dissect this a little bit more, it meets that criteria once again, that it's one. It has weekly options. Let me jump back over here really quickly and let me show you the dividend on this one. So the dividend on this one is nice, right? It's over 5%. It's paying about 48 cents every quarter. But you're using these option strategies to enhance that, right? To give yourself a dividend weekly, right? Not just monthly. You can do it monthly, right? You can do it monthly, and I don't discourage that. But this concept is trying to supplement your income on a weekly basis, getting the premium that you receive for these options that you marry to these shares, and then that premium you never have to give back. You keep that premium. Yeah, what I would do is take at least, or not least, or as much as half of that premium that you receive, and kind of live off of it. Supplement your income. So anyway, if we jump back over here to this Walgreens one, and it's 7 days ago, this is a lower stock amount, so it's going to be a little harder to get a significant amount of premium for this over a week. But it's all based on percentages. But when you're looking to supplement your income, you're trying to think about absolute dollar amounts. So if we look at this one here, we can sell the put. That's the strategy. Selling the naked put, that's bullish. We can do that. That would give us about 39 cents if we sold that 36 put, right? And then we have a 68% chance of winning. We could do the covered call that we talked about, and we can sell that at the money. That's going to give us about 60, almost a 60% chance of winning at expiration. That's going to give us a potential to make about $70, but you're not getting a lot, right? $30 for the extrinsic, right? We can turn that covered call into a collar and do something like this, right? So now the premium we're receiving is only about $9. The most we can make is $50. The most we can lose is $50. This is literally 1-to-1 with this collar strategy. So that's nice. You're making $50 off. You can potentially make $50 in 7 days off a $36 stock. That's more than the dividend that we just looked at, right? If we go back over to this thinkorswim here and you look at the dividend was $48, right? So that's, when you do that in a week, that's to me is super powerful. If you didn't want to do it this way, you can decide, okay, I think Walgreens has been in the range. I think it's going to shoot up in the next 7 days or in the 30 days. You can set this up as a Bionic Bull, as we talked about. And then if you do the Bionic Bull, you can do something like this. This is going to give you a 55% chance of winning at expiration, and you got unlimited potential to the upside. You get a credit of $11. Or you can structure it a little bit differently. Do something like that, increase your probabilities of 60% there. But it would have to jump quite a bit, or a dollar. That's a lot for a $36 stock. But this is what I want you guys to start thinking about, having a safeguard type of strategy, and at least your IRA accounts. You can do it in a margin account. We're demonstrating this process in the margin account here. This is definitely a margin account. And then you find what you can be a core for you. Use this safeguard strategy so that you can make money as the market goes up, and you can limit your losses to the downside and keep lowering your cost basis as you sell options against your shares. All right. So any questions regarding this type of process?